Welcome back to another deep dive. Today we're plunging into, well, a truly fascinating high-stakes story, Duos Technologies Group, Inc.
That's DUOT on the NASDAQ.
Exactly, DUOT. Currently sitting around $6 a first cent a share as of August 21st, 2025. And this isn't just about a stock ticker. It's really a gripping tale of a company standing at a serious crossroads.
Yeah, you've got this tough past, right? Historically plagued by losses, colliding head-on with an incredibly bold vision for the future.
Precisely. Can this small, specialized rail tech company actually pivot successfully into these, well, white-hot markets, AI-driven edge computing, fast power, energy solutions?
Or is it just a super high-risk gamble, fueled by, dilutive capital raises and really banking on one single pivotal contract?
That's the core question. So our mission today is to equip you, the listener, with a comprehensive understanding of this complex transformation. We'll examine the business model, the management, the financials, and of course, the risks and opportunities.
It's a compelling narrative. What's really striking is, like you said, Duos isn't just tweaking things. It's a complete metamorphosis.
A total reimagining of what the company is and what it aims to be.
Yeah, exactly.
Okay, so let's dive right in and unpack this transformation.
Business analysis, the great pivot.
Let's kick off by understanding what Duos Technologies even is anymore. If you knew them primarily as a rail tech company, well, get ready for a pretty significant update.
Big time. In 2024, they undertook this fundamental strategic shift. They moved from being, a niche rail tech provider to operating through three distinct subsidiaries.
Right. So first, there's Duos Technologies, Inc. That's the legacy rail business.
Correct. Then you have Duos Edge AI, Inc., which was formed in July 2024. That's their push into next-gen computing, the Edge AI space.
And number three,
Duos Energy Corporation. That came along later in 2024, tackling these energy solutions.
and this wasn't just cosmetic, was it? I mean, their whole revenue structure seems to have flipped upside down.
Oh, completely. It's a seismic shift. Historically, their technology systems revenue, that came from lumpy project-based hardware sales at their railcar inspection porters, the RIPs, big one-off deals.
But that's not where the action is now.
Not really, no. That part's minimal now, mostly due to customer-side delays on those big projects. The real story, the part generating almost all the cash right now, is services and consulting.
And that's their shift towards recurring revenue, right?
Exactly. This bucket includes maintenance contracts for the rail systems, some AI as a service stuff, but crucially, these high-margin management services coming from Duos Energy.
How crucial are we talking?
Get this. For the first 6 months of 2025, that single segment accounted for $10.59 million out of their $10.69 million total revenue. It's almost everything.
Wow. And that's mostly from one specific deal.
Pretty much entirely driven by one massive contract, the Asset Management Agreement, or AMA, with a company called New APR Energy.
Okay, that kind of revenue concentration is definitely something we'll need to circle back to. But I also heard about an even more, maybe futuristic, revenue stream they're working on.
You're right. There's a third emerging stream. That's hosting revenue. It comes from Duos Edge AI through their edge data centers, or EDCs.
So mini data centers.
Essentially, yeah. Designed to process data closer to where it's created, cutting down latency. This revenue stream is still pretty small, just getting started, but the idea is it'll grow significantly as they build out more EDCs and sign up what they call anchor tenants.
Anchor tenants.
Yeah.
So the first big customers to commit.
Exactly.
Okay, so let's break down the actual products and services across these three subsidiaries. First, the legacy rail business, Duos Technologies, Inc. What's the core product there?
That's all about their patented RIP system, Railcar Inspection Portal. And it's genuinely sophisticated stuff.
How so?
It's an AI-driven system, does 360-degree inspection of trains moving at up to 125 miles per hour. It spots defects, potential threats, all in under 60 seconds.
And who uses these?
They're deployed with Class 1 railroads. So we're talking the biggest freight carriers in North America. It's serious technology for serious customers.
Okay, then Duos Edge AI, Inc. What are they actually selling or building?
Their focus is deploying those modular edge data centers, EDCs. The goal is bringing high-speed data processing closer to users, especially in underserved rural areas. They call them Tier 3 and Tier 4 markets.
So places like remote schools, rural hospitals, local governments maybe?
Precisely. Places that often lack reliable, high-speed data access. Their pitch is basically data uptime on-site services that are better, faster, and more economical than relying on distant, centralized cloud data centers.
Makes sense. And then Duo's Energy Corporation, what's their specific role?
This subsidiary is laser-focused on executing that critical 2-year, $42 million asset management agreement, the AMA, with new APR Energy.
So they're managing assets for new ATR Energy.
Exactly. Providing comprehensive consulting and asset management for mobile gas turbine generators. What's really interesting here is their asset-light model.
Meaning they don't own the expensive turbines themselves.
Right. They're not buying and owning the generators. Instead, they're leveraging their management team's deep expertise, a lot of whom came from APR Energy, actually to provide the service and collect those high-margin fees. It's a lean way to play in a capital-heavy field.
Very interesting approach. So zooming out, market position and scale, they're still pretty small overall.
Oh, definitely. Still a microcap company. Market cap around $121.3 million. So yes, established in rail, but still a small fish. And in edge computing and energy services, they're really just emergent players. Very small scale, leaning heavily on partnerships like that AMA to even get started.
So the value proposition is quite varied. Rail, safety, efficiency, cost cuts. Edge AI, secure, low latency computing for underserved areas. Energy, specialized management expertise for complex power assets. It's quite a mix under one roof now.
It really is. Which naturally brings us to the wider industries they're stepping into.
Let's talk industry analysis then. What are the big trends Duos is trying to ride with this pivot? Sounds like they're aiming for some powerful tailwinds.
They absolutely are. They've positioned themselves at the intersection of 3 really significant high-growth trends. First, rail inspection and automation. That's a steady market, maybe 6% CAGR.
Driven by what?
Aging infrastructure, safety regulations getting tighter, and more use of AI for predictive maintenance. Solid, predictable drivers.
Okay, second trend.
The broader transportation technology sector, that's growing explosively. We're talking a projected 24.2% CAGR between 2024 and 2030. And within that, railway tech is actually pegged as the fastest growing subsector.
Wow. But the third one, that's the really dynamic one, isn't it? Edge computing and AI infrastructure.
That's the sizzle, yeah. Management literally called it super hot demand coming from the data center computing gold rush. It's driven by the crazy growth in AI and the absolute need to reduce latency processed data faster, close to the source.
An almost unimaginably massive opportunity, it sounds like.
It is. But, massive opportunity usually means massive competition.
Good point. Who are they actually up against here?
Well, in automated rail inspection, it's established firms. Think Wabtec, NSO Rail, PSI Technics, wayside inspection devices. Duos is a niche player there.
But in edge, AI, and energy...
That's a whole different ballgame. They're stepping into the ring with absolute giants, large, very well-capitalized infrastructure developers, big utility providers. Duo's angle, their potential edge, is this unique integrated model across rail, AI, and energy, if they can pull it off.
That's a huge if, and the regulatory side in rail is pretty strict, right? FRA, AAR rules.
Very stringent, which actually creates non-discretionary demand for inspection companies have to do it. But you also have that ongoing tension, right, between the industry associations wanting more automation and the unions worried about safety and jobs. That's a factor.
Definitely. What about barriers to entry?
High in rail, lots of R&D needed, specialized knowledge, long sales cycles, regulatory hoops to jump through. In data centers and energy, though, the main barrier is just capital. Lots and lots of money.
And Duos is trying to navigate that.
Yeah, with the asset-light model for energy, like we said. But for Edge AI, they're going with build, own, operate. That means they need serious cash, which leads directly to those financial challenges and their reliance on, dilutive equity financing, selling more stock to fund it.
Okay, so given all that, what's their actual competitive advantage? Do they have a real moat?
Well, their brand strength is niche. North American rail, mostly.
Right.
Minimal elsewhere for now. And being a microcap, they don't have cost advantages or economies of scale yet. That's the goal, not the reality.
Any switching costs for customers?
Moderate for the existing rail customers once they're integrated with Duo's proprietary software. But for the new businesses, Edge AI and energy, there isn't really an established ecosystem yet that would lock customers in.
So where does the real advantage lie, if anywhere?
Well, they do have unique assets. The patented RIP tech, those 53 proprietary AI use cases for rail inspection, that's real IP. But honestly, the most distinct advantage, the thing that makes this whole pivot possible, is the specialized management expertise.
Specifically the CEO, Chuck Ferry.
Exactly. His background and network are key. That AMA contract, it only happened because of him and his team's history at APR Energy. That's their ace in the hole right now. And the biggest potential differentiator is that ambitious, synergistic, three-subsidiary model itself, if they execute.
Which leads us perfectly into looking at management more closely.
Management evaluation, the jockey bet.
All right, assessing Duo's leadership really comes down to one central figure,
Okay.
CEO Charles Chuck Ferry. He came on board in September 2020, and his background is, well, it's extensive.
Yeah, quite the resume. 26 years, U.S. Army Infantry Ranger Special Ops, then Lockheed Martin. Then he grew Aramid Global, like tenfold to $200 million revenue.
Then after that,
Led APR Energy, COO, President, then CEO, managing $325 million in revenue, a 2.2 gigawatt fleet. This guy has serious operational experience, especially in scaling complex businesses.
and it seems like this whole radical pivot at Duos is a direct result of that specific experience and his network, right?
Absolutely. That massive AMA contract with new APR Energy, the one driving nearly all their current revenue, it was possible, frankly, only because Ferry was the former CEO of APR Energy, and a lot of the Duos team are APR alumni.
So the whole investment case really feels like a jockey bet on Ferry himself.
It largely is, which also brings up that interesting point about his dual role. He's CEO of Duos and Executive Chairman CEO of APR Energy.
Which normally screams conflict of interest.
Normally, yes, but here it seems less like a conflict and more like the crucial enabler for that AMA deal. It's a unique, very concentrated synergy. Still a risk, relying so heavily on one person and that relationship, but it's also the key that unlocked this whole strategy.
That's a fascinating dynamic. Relying so much on one person, even a very capable one, definitely feels like a risk factor we need to keep in mind.
Oh, for sure. It's a major concentration risk. If he leaves, or if that relationship sours, what happens to the AMA? It's a key reason for using a higher discount rate when you try to value this company, as we'll get to.
Okay. How about their communication and transparency?
They seemed pretty regular with communication, earnings calls, press releases, SEC filings. They've been quite open about the rail business delays and the reasons for the pivot.
Any ethical red flags?
No major scandals mentioned. However, our research did flag a third-party Benesh score. It suggested a historical possibility of financial manipulation. It's basically an accounting red flag detector. Doesn't mean anything definitively wrong happened, but it warrants, just being extra cautious when looking at the historical financials.
Good to know. Now, how are they allocating capital? Where's the money going?
It's aggressive reinvestment into growth, specifically building out that edge data center network. They funded this with some big capital, raises a $40 million upsized public offering, and a $12.5 million at-the-market, or ATM, offering.
And the plan for that cash?
The stated goal is funding 15 EDCs in 2025, and then an even more ambitious 50 EDCs in 2026. It's all focused on organic growth right now, no M&A talk.
So no share buybacks, no dividends then?
Nope. All growth funded while issuing new shares, which, predictably, has led to massive shareholder dilution, a staggering 152.5% increase in the share count over the past year.
Ouch. That definitely frames it as more of a venture capital style bet.
Absolutely. And when you look at their return on invested capital, ROIC, it's deeply negative.
Yeah.
Minus 62.33% for the trailing 12 months. That indicates significant historical value destruction.
So the core challenge for Ferry and his team is turning that around, making these new, supposedly higher margin businesses actually generate a positive return.
That's the entire game right there. Can they make this pivot not just grow revenue, but actually create value? It's a very, very tough tightrope walk.
Which brings us neatly to the numbers themselves.
Financial analysis, the numbers game.
Let's dig into the key metrics. Market cap, as we mentioned, around $121.3 million. Firmly micro-cap territory. What does that mean for you listening?
Well, potential for higher growth, sure, but definitely significantly higher risk and volatility.
Definitely. Now, revenue growth. The 5-year history is volatile. Bounced between roughly $7 million and $15 million from 2020 to 2024, but then Q2 2025 hit, and boom, 280% year-over-year growth to $5.74 million.
Almost entirely from the new energy services, right?
Exactly. Trailing 12-month revenue is now $15.39 million, and the big number is their full-year 2025 guidance, $28 million to $30 million. That's nearly a four-fold increase over 2024 if they hit it.
Okay, that top-line growth is impressive, but what about profitability, the margins? That's where the story gets, well, more complex and currently quite challenging. Gross margin for the trailing 12 months is 22.24%. But there was a significant recent improvement. Q2 2025 gross profit hit $1.52 million. That's a 26.5% margin.
Which is a big turnaround.
Huge turnaround from negative gross profit the year before, directly thanks to that high-margin AMA contract. However,
There's always a however.
Operating and net margins are still deeply negative.
Yeah.
We're talking TTM operating margin of minus 66.52%, TTM net profit margin minus 67.62%.
So even with better gross margins from services, high overhead and growth investments are just eating everything up.
Pretty much, leading to substantial bottom line losses.
And how's the cash flow situation? Are they generating cash yet?
No, not even close.
Yeah.
Consistent history of negative free cash flow over the last 5 years. They're burning cash.
How much?
TTM free cash flow is negative $9.73 million. That's operating cash flow of minus $7.42 million, plus capital expenditures of minus $2.31 million. It just confirms they constantly need outside money, stock, or debt to cover the losses and fund that expansion.
Okay, so financial stability sounds like a major concern.
It is. Consistent record of significant net losses for 5 years straight. TTM net loss is over $10 million. Management is optimistic about maybe hitting adjusted EBITDA break-even in the second half of 2025.
Which would be a milestone.
A huge milestone, yes. But it's still just adjusted break-even, and it's not guaranteed.
What about debt?
Debt-to-equity ratio is 1.66. For an unprofitable cash-burning company, that's significant financial risk.
And this next one sounds worrying. The current ratio.
Yeah, this is a major red flag. Their current ratio is 0.37. That is dangerously low. It suggests a potential inability to meet short-term obligations. They also have negative working capital of minus $8.30 million.
So simply put, they're losing money, burning cash, and might struggle to pay near-term bills without more funding.
That's the picture. Highly dependent on converting that backlog into actual cash and accessing more external capital. And obviously, no dividends.
Okay. Given all that, how do you even value a company like this? PE is useless with negative earnings.
Right. PE is not meaningful. Their price-to-sales ratio is around 4.000 TTM, but it's been incredibly volatile, reflecting all this uncertainty.
So to get some sense of potential future value, we often use a discounted cash flow model, a DCF. Can you briefly explain that?
Sure. A DCF model tries to estimate a company's intrinsic value by forecasting its future free cash flows, the cash it might generate after all expenses and investments, and then discounting those future flows back to what they're worth today, using a discount rate that reflects the risk.
And we ran an educational DCF model for duos. What did it suggest?
Our educational model came up with a pretty wide estimated intrinsic value range, $7.50 to $14 per share, with a base case scenario around $10.50 per share.
Which is notably higher than the current $6 or 4 cents price.
It is. And this is but that valuation is extremely sensitive to the assumptions you plug in.
What were the key assumptions driving that value?
Very aggressive ones. Initial revenue growth of 150% in the first couple of years, tapering down to still high 20-40% in years 3 to 5, reflecting that EDC build-out.
And profitability.
That's the most speculative part. We had to assume those high-margin services and hosting revenues eventually cover all the costs, leading to positive operating margins, targeting maybe 10-20% eventually. And crucially,
the discount rate.
We used a very high discount rate, a WACC, or weighted average cost of capital, between 16% and 20%.
Why so high?
Because of everything we've discussed. Microcap status, high transformation risk, weak balance sheet, history of losses, massive execution risk. You have to demand a higher potential return for taking on that level of risk.
Makes sense. So a potentially high valuation, but built on very aggressive assumptions and high risk. Okay, let's shift gears and see how the market is actually perceiving this complex story.
Market sentiment analyst optimism versus market skepticism.
Looking at market perception, especially Wall Street analysts, well, they seem pretty optimistic, don't they?
Overwhelmingly so, at least the ones covering it. The consensus among the two analysts providing forecasts is a strong buy.
And their price targets.
The average one-year target is in the $12.50 to $12.75 range. High target is $14.70. Low is $11. The midpoint suggests, what, about 108% upside from the current $6.04 price?
That's a massive gap between analyst expectations and where the stock is actually trading.
It really highlights the tension, doesn't it? Analysts seem to be buying into the transformation story, while the broader market is clearly much more skeptical, pricing in a lot more risk.
And what about recent news flow and media coverage? What's the general tone?
It's very mixed, reflecting that core tension. You see headlines about the 280% revenue jump, excitement about AI and edge computing expansion. But then the next article focuses on the widening net losses, the cash burn, the rail delays, and the reliance on dilutive financing. It perfectly mirrors the bull versus bear debate.
Okay, what about market indicators? Anything interesting there? Short interest.
Short interest is actually relatively low, about 2.3% of the float. That's around 370,000 shares shorted. Suggests there aren't huge concentrated institutional bets against the company right now.
That could be seen as a positive, or at least not a strong negative. How about technicals? Moving averages.
Technically, it's looking a bit shaky short term. The stock is currently trading below its 50-day moving average, which sits around $7.41. That's generally seen as a bearish signal.
And the longer-term 200-day average.
That's where it gets really interesting. It's trading just slightly below its 200-day moving average, which is around $6.31. That level is often seen as a critical technical point. If it can't reclaim and hold above that 200-day MA, it could signal a more sustained downtrend is likely. Definitely a key level to watch.
Okay, so technically precarious. Let's talk about who actually owns DOT stock.
Ownership structure. Who holds the keys?
Well, institutional ownership is relatively low here. Only about 15.8% of the outstanding shares are held by institutions, spread across 27 of them.
Any big names in there?
The largest holders include Blycroder LP, Vanguard, Royal Bank of Canada, and Morgan Stanley. Recent activity is mixed, but interestingly, some of those big players, Vanguard, RBC, Morgan Stanley, have actually increased their positions lately. That could signal some belief in the turnaround story, maybe.
It could be, or just portfolio adjustments. Hard to say for sure. But it's not like they're all fleeing.
What about insiders? Management ownership.
Insider holdings are quite significant, actually. About 17.1% of the company, valued around $22 million. That's generally a good sign, aligns their interests with shareholders. Skin in the game.
But are they buying more shares on the open market?
That's the catch. There have been no open market purchases by insiders in the last 12 months. And in fact, the CFO, Adrian Goldfarb, sold over 10,000 shares back in May 2025, around $7.85 per share.
So high ownership, but no recent buying and some selling. What does that signal?
It's a bit ambiguous. It could suggest that even insiders, despite their large stakes, don't see the current price as a screaming bargain. Or maybe it's just portfolio diversification, but the lack of buying is certainly notable.
Who's the biggest owner overall, then?
The general public. They hold about 67.1% of the shares. It's a relatively diffuse ownership structure. The top 25 shareholders combined own just under 32%. And a large public float like that means?
It means the stock can be quite susceptible to retail investor sentiment, news flow, maybe more volatility than a stock tightly held by institutions.
Okay, so putting it all together, what does the overall risk profile look like?
Risk assessment, the tightrope walk.
Let's break this down with a classic SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the core strengths for duos?
Okay, strength. They definitely have proprietary technology, the RIP system, their AI use cases. That's a real asset. Proven executive leadership in Chuck Ferry, his track record and network are key.
Anything else?
They have a growing revenue backlog, reported at $40.7 million, which gives some visibility. And that unique integrated business model, if they can make it work synergistically, is a potential strength.
All right, now the weaknesses. Sounds like there might be a few significant ones.
Oh yeah, it's a substantial list, and they're kind of interconnected. Number one is just precarious financial health, chronic unprofitability, high cash burn, that scary 0.37 current ratio suggesting liquidity issues, high debt to equity at 1.66, negative working capital. It's a tough picture.
And the dilution.
Exactly. That history of massive shareholder dilution is a major weakness, plus ongoing operational challenges in the legacy rail business. And, as we've stressed, extreme concentration risk relying so heavily on ferry and that single AMA contract.
Okay, but the flip side is the opportunities, right? That's the reason for the pivot.
Absolutely. And the opportunities are immense. They're targeting huge addressable markets, AI infrastructure, edge computing, decentralized power. Regulatory tailwinds in rail safety are pushing for more automation, which helps their legacy business. And there's a big opportunity to scale a recurring revenue model, moving away from those lumpy project sales.
Now for the threats, what external challenges do they face?
Intense competition, especially in the new markets. They're up against giants with much deeper pockets. Significant execution risk, actually deploying 15 EDCs this year and 50 next year. That's a massive undertaking for a microcap. Huge risk there.
And supply chains.
Yeah, vulnerability to supply chain disruptions is a threat, especially for hardware like the RIPs and EDCs.
What about broader macroeconomic factors? Inflation, interest rates.
Both are threats. Inflation increases their costs, squeezes those already thin or negative margins, and could cause customers to delay big projects. Higher interest rates make their debt more expensive and equity financing harder or more dilutive tough for a company that needs capital.
Any specific geopolitical risks?
Well, Those U.S.-imposed tariffs mentioned for 2025, potentially on tech components from Asia, that could directly hit their hardware costs for RIPs and EDCs, further compressing margins and maybe causing delays in that aggressive rollout plan.
Okay, that paints a pretty clear picture of the risks and rewards.
Yeah.
Let's try to synthesize all this.
Conclusion. A story stalks crossroads.
So this deep dive into Duos Technologies Group really reveals a company of, well, stark contrasts.
Yeah.
It feels like a true tale of two potential outcomes. There's a clear, compelling bull case.
Absolutely. Driven by CEO Chuck Ferry's leadership, his track record, and this audacious strategic pivot into high-growth markets like AI, edge, and energy. It's already showing results, right? That triple-digit revenue growth, improving gross margins.
Plus that visible $40.7 million backlog and the aggressive EDC deployment plan offering a clear roadmap for future growth. It's a compelling story.
It is. But then there's the equally potent bear case, rooted in that foundation of undeniable financial fragility.
Right. The troubled history, negative ROIC,
Okay.
consistent cash burn, big net losses, that dangerously low current ratio signaling real liquidity risk.
Plus the massive shareholder dilution needed to fund this pivot, and the extreme concentration risk relying so heavily on one person and one contract. It feels like a very fragile foundation for such a grand ambition.
So, revisiting our educational DCF model again, emphasizing educational, it suggested that wide intrinsic value range, $7.50 to $14, with a base case of $10.50, significantly above the current $6.04 price.
Correct, but it cannot be stressed enough that valuation hinges entirely on successful execution of this incredibly ambitious plan. And most importantly, achieving sustainable profitability, which, given their history, is very far from a sure thing.
So how do we sum up Duos Technologies?
It's really a classic story stock. The current market price seems to be baking in a high probability of failure, or at least significant bumps in the road. You see that in the gap between the stock price and analyst targets, or our DCF range.
But if they succeed?
If the strategic plan works, if they capitalize on these huge markets, the rewards could be substantial. It's the epitome of high risk, high reward, a narrative of transformation where the ending, financially speaking, is still very much unwritten.
So the final provocative thought for you, our listener. Given the immense potential and the significant hurdles we've discussed, what's your take on Duos Gamble? Is it a masterstroke of strategic vision by Chuck Ferry, or is it more like a tightrope walk over a financial abyss? Something to definitely mull over. We really hope this deep dive has given you a comprehensive understanding of Duos Technologies, truly a company at a fascinating crossroads. If you found this analysis insightful, please do remember to like this video and subscribe to the Stock Analytics AI YouTube channel.
Yeah, and for our members, it's just $4.99 a month. You get priority deep dives on tickers you request. Plus, over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And if you just want a one-off deep dive on a stock that's caught your eye, you can always drop us a super thanks right here on YouTube.
And finally, the important disclaimer. This analysis was generated by an AI system. It's purely for educational purposes.
That's right. It should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us for this deep dive.